when you get started in real estate, it's really easy just to get straight into it and go out, oh, there's a house, I like it, I'm going to buy it, which is pretty much how I started, by just diving right in. But it's much better to have a strategy. So I'm just going to talk you through my 5 top tips to getting into real estate. And bear in mind, there's way more than 5 tips. This is just 5 of the big hitters for me in my experience. So the first one is knowing your bigger strategy. And I rant on about this all the time, because if you just go out and buy your first property without thinking about what your exit strategy is at the other end, you may just end up going in all these different tangents and directions, buying property that perhaps doesn't really serve you. And my example of this is that when I got started, we bought our first 1 or 2 without really thinking about how is this going to actually help us in the long run for our exit into, say, financial freedom. We just bought 2 very simple tenanted rental properties which bring in a little bit of positive cash flow. As it happens, those properties have been cash flowing since day one, and that's great. But perhaps I would have done it slightly differently. Knowing your bigger picture or knowing your bigger strategy has a lot to do with starting at the end with the end in mind. So when you look at your exit into financial freedom, or whatever it is for you that you want out of property, what does that look like? For us, it's X amount per month that covers all of our expenses, or X amount per year that covers all of our expenses, holidays and living. So we can then choose and have freedom around the decisions we make in our lifestyle, where we live, what we do and so on, and how we work. When you know that final outcome, you just need to take steps back from there to work out what the first step is. And the best advice I can give you on this is to find a strategist, somebody who knows the process and has gone through the process of completing a portfolio, coming out at the other end, and then can help you do the same for yourself. There's a lot of people out there who do this. It's challenging to find one that works because there's often a vested interest. Sometimes they're referring you to a developer to buy property and then getting a backhand, often called spruikers. But there are specifically property strategists out there who can just literally discuss your plans that are catered to and tailored to what your needs are. And you may pay them for that. And I would happily pay a strategist if it means I'm going to spend less time wasting time buying property I don't need, when I can actually put a plan in place and go. You don't really need more than 4 or 5 properties to be able to bust out the other end and become financially free. Often we think, you need a big portfolio of 10, 20, 30 more properties. And whilst that would be lovely, you don't need that to get your expenses covered. Think of the bigger strategy. That's tip number 1. Number 2 is really obvious, but lots of people don't do it. Run your numbers, people. Know your numbers. Know yield, cash flow, return on investment. Wash its face is a term I've heard before. Know the minimum offer you can offer on a property based on the numbers, based on how much you're going to spend on it, what the expected value is, what the expected income is, what the mortgage rates are. Stress test your numbers at different mortgage interest rates so you know that it will still work regardless of whether the rates go up or down or the market changes. All my properties are positive cash flow. I'm not really into negative gearing. However, that is a strategy we're looking at later down the track when our portfolio can support a negatively geared property. I don't want to pay out of my own pocket for any of our properties. With that in mind, knowing your numbers means that you get the right properties in the right place, all cash flowing, so you're not caught short when the interest rates drop or when external factors come in and you're unable to keep that property. Let's say you're over leveraged with the bank at 100% and you've got it on a nice good interest rate, and then suddenly the market shifts and the interest rate goes up and the area you're in maybe dives in value, and heaven forbid that happens, but it can happen, it does happen. Then you're caught short with a property with negative equity in it and a high interest rate and not enough rent coming in to cover the cost of your outgoings. Worst case, but it happens. Tip number 3 is area qualification, and whilst again this is quite obvious, we don't do enough. We tend to go, okay, that area looks good, this property is nice, oh lovely, this could pull a rent. Maybe you'll jump onto realestate.com.au and do a bit of research, or whichever country you're in, you'll do a bit of research, and you're pretty happy with it. But there's detail to area qualification. For example, if with our UK property, when we were looking at buying that, if I'd just bought it based on face value or based on the advice I was given by the sourcing agent who found the property for me, maybe it wouldn't have been a good decision. But what I made sure of is that I knew exactly what the area was like in terms of rental expectation, in terms of demographic, quality of tenant, demand, the values in the area, if I'm going to add a conversion, is it going to be worth it, and so on. So the way I do that is calling rental agents, letting agents, calling sales agents, asking them specific questions to tell me what that area is about. I didn't go to the UK when we bought that property. So for us, I was flying blind, and I relied on the information of other people to make sure that it was the right decision for me to buy that property. So I spoke to numerous agents and said, hey, this particular postcode, this particular street, what's it like for rentals? Do you have any rentals on it? Have you had any trouble finding tenants? Which properties are the most popular to rent out? If I was to come to you today and say I have the perfect property that would sell tomorrow, what would that look like for your buyers? Those kind of questions agents love, because one, they see that you're potentially going to be a client of theirs. So they're going to freely give up that information. And two, it's their job. So you're asking them relevant questions and they'll be happy to tell you. And the great thing about the UK letting agents, in many cases, when you find a good one at least, is that they know that one side of the street is good to rent on and another side of the street is not. So you can get that really good, juicy information. Number 4 of the 5 top tips to investing in real estate is consider using a buying agent. I always went out and looked at the properties, found them myself and so on. And whilst I recommend you do that, because you do need to know the process. You need to know how to do it. But at some point, you need to hand that over to someone else, because if you want to scale a portfolio and grow, you need to leverage other people's talents and skills and place your focus on the areas that you're most talented at and skilled at. And for me, I'm not great at going around to the property and negotiating with the agents and spending that time, because if you think about it, many people work full time. That's Monday to Friday maybe, and then you're spending all weekend viewing properties. When do you ever get time to live? So leverage someone else's time to be able to bring those properties to you. There's a cost associated. If there's not a cost associated, ask the question, how do they get paid? Because often if it's a buying agent, they'll be working for the developer, which means you might not always be getting the best deal on a property. That's something to consider. Again, I mentioned spruikers. There's a few out there, best to be aware of them. There is a cost, but it's sometimes, if I think, well, how much time would I spend finding that perfect property and what's that time worth? It's sometimes worth paying someone else to do it for you. But do your due diligence on the right kind of buying agents, and I can recommend a few that I've spoken to who I genuinely think are good people. Tip number 5 is adding value, forcing value into your property. Don't rely on the market to shift upwards and give you the capital growth that you need. And whilst that is a strategy in some cases, capital growth, buying in a growth area, creating value before you've even bought the property is how you can make that money before you even buy. So the money's made in the buy, they say. The money's made in the buy. So you might buy a property below market value, very simple. Maybe it's distressed property or distressed sale. There's options there. Or when you buy it, you may have a long settlement time and you can get access to that property to start work. It might not be major works, but you can start clearing it and getting it ready for sale or rental early. So you're adding that value early. Buying a property that needs work allows you to then force in that value by doing a renovation. For anyone getting started, that's where you get the value, not in the capital growth. The capital growth, for me, my opinion, is the cherry on top. So that's 5 tips. Know your biggest strategy. Think about getting a strategist, running the numbers, reaching out to someone who runs numbers, loves numbers, and get help if you don't know how. Area qualification, make phone calls, speak to people, do your research. Consider using a buying agent. Really just leverage other people's time and energy and talent, and adding value, forcing value, create the value in the property when you buy it. Winding up now, thanks so much for watching.